connecting. It's good. Hello, everyone. This is Len Yates, president of OptionVue, and we'll be talking today about version 7.30, just released this morning. Now, let me take a moment to share the desktop. Okay, so everyone should be able to see my OptionVue program. Quite a lot of improvements went into this 7.30 version. Main one is a new horizontal skew model, which will be the only focus of my talk today. It's quite a deal, and I think quite an important step in terms of modeling options the way they really behave and how they really respond to price movements in the underlying. So to begin by talking about what began this project, I realized that a couple of things were foundational to it, and one was data. We needed some data that we didn't have before, so I needed to construct it. Now, let me by showing you what this looks like. If we bring up a volatility chart, the mode you would see in OptionVue would be these two lines, IV and SV, but it's a new button here with an M on it, and when you do that, the program toggles between a new 5-line mode in the single-line mode. So now instead of having just one IV line, we have 5 IV lines, also statistical volatility, also a total of 6 lines. The blue line represents near-term volatility, the 30-day. Thin line represents 60 days. And we've got turn way out to long-term 2-year implied volatility. So we gathered on all of the assets that we represent here at OptionVue, everything that has options, all back to 5 years ago. So we have 5 years worth of data to use, and perhaps at some point pursue deepening that history. The next thing I want to show you is perhaps one of the most interesting things about this model. That is that to look at a volatility cone now. If you click to place a wand on the chart, the volatility cone shows up. And it shows you the structure of volatility. And if you're not familiar with that, I hate to say the word term, but if you're with that word term structure, fit like this. We're all used to saying short term and long term, right? Well, term structure shows you short term, medium term, long term all at once. So what a term structure is, and actually when we're talking about the new horizontal skew model, we're talking initially about a term structure model. So that's what this is. Maybe you notice that as you move the wand, the structure changes and goes all over the place. And by the way, the shaded area in the volatility cone represents the extremes that we've gone to during the last 3 years. During 3 years, we went all the way to the line. Let's see if we can find that. Now, this comes pretty close. And I'm sure that would have been probably in the fall of 11. Yeah, so there's where the term structure reached its highest point during the last 3 years. So you can begin to see that this volatility cone is going to be very useful and may analyze, for example, earnings announcements. I had an earnings announcement 3 months ago, and IV soared at that time and then suddenly dropped right after the announcement. Drop. 3 months prior to that, again, very high IVs and then sudden drop. You see that. So this historical data was foundational to creating the model, and it comes with your price data. So whenever you're updating your price charts, you're also updating these volatility numbers because they're stored in the same file. So, okay. Now, let's see. Point I want to make is that notice we're missing today's numbers. You won't not have today's numbers on the chart. You've not opened the matrix yet today. I have not opened my Apple matrix yet today, so I will open it now. It's updated, and we can return to the chart. Steps to reopen it. Let's reopen that chart. Today's numbers. How you extend the chart to include today's numbers. Just open the matrix. Now, the thing that was foundational to making a model as sophisticated as this, and I'll bring up PowerPoint here. CEV data. We did new CEV data. Now, what is CEV? Just a reminder, CEV is constant elasticity of volatility. And that simply means we're measuring the degree to which IV numbers change in response to price changes in the underlying. CEV is an industry standard term. We did not make that up here at OptionVue, so we're just using an industry standard term. Now, the thing that's new is instead of having just one CEV number per asset, we need 15. And that's so that we can more appropriately model CEV according to the situation. Okay, so for example, let's say we're looking at a short-term option that's got 30 days of life remaining. And looking at modeling a move that takes place in just one day. Okay, the CEV that's appropriate for that situation is 0.837. Probably remind you that numbers that are below 1 in an inverse relationship between price and volatility. Okay, like everyone understands and probably knows that stocks all have CEVs under 1, which means that when falls, volatility increases, and when price rises, volatility decreases. So with all stocks and stock indexes, you will see CEV numbers that are less than 1, and that's that inverse relationship. But there are some assets, especially in commodities, that have CEV greater than 1, and in those cases, when it goes up, volatility goes up, and when it goes down, volatility goes down. And so, again, just to show you another example, we're looking at an option that has about 90 days of life remaining. And I didn't mean to change that. Let's see if we can put it back there. And we're looking at the line making a move in 5 days or so. The appropriate CEV that the program will use is 0.915. I found that as I did my studies that there really wasn't much point in taking in numbers that were above 10 days in terms of a move. As you go out in time, as far as the number of days for the movement, numbers really didn't change very much in my observation. So the 30-day number of 0.904, for example, just stayed 0.904 on as you went farther out. Sufficient, I found, to have this 1, 5, and 10 in terms of the quickness of a move, and then option durations of 30, 60, 90, a year, and 2 year. We have an option that's expiring in 15 days. What do we do with that? Well, to extrapolate, and that's just what the program does. So you have the 60, that's 0.87, and then 30, that's at 0.837. The 15-day is going to be somewhat less than this 0.837. You just extrapolate it out linearly. Okay, what the program does. Or if you need a number that's in between some numbers, then use what's called interpolation. And again, using linear modeling, you just find a number that's between there. So, for example, if you had a 45-day option and you needed the appropriate CEV number, the program would take a perfect average between this number and this number. And I'll clear to everyone. This is technical. Really, all I wanted to say about it. So let's turn our attention back to the program now, back to application. Okay, let's open a price line matrix. I was looking at that earlier. And I'd like to introduce you to the new model. You would find it in the program using Model, and then click Volatility. This will look all different to you. A new tab for horizontal skew. Next tab is vertical skew, and some of this will look familiar to you. What we did with this table here is widen it so you can see more months. And miscellaneous things under the other tab. But horizontal skew, we have here in the upper right corner is a repeat of the volatility cone. And the term structure depicted right now is current term structure. Okay, so we currently have a term structure that has higher nearby volatilities and then less and less as you go out. The bottom section is put here pretty much to illustrate CEV for you. In case you've never truly grasped CEV, this ought to do it for you. The horizontal axis in the chart is price of the underlying, with the current price in the center. The vertical axis is volatility. So if you met the lines go up as you go down, and that's showing you that volatilities increase if the stock goes down. And conversely, if you go up to prices, then volatilities decrease. And what's happening to the term structure up in the volatility cone, it's that I do this. Okay, just release the mouse and this reverts to showing the term structure. But then you can play with. Here in this table, we are showing 5 of the 15 CEV numbers. I'll tell you which ones we're showing. Let me return to PowerPoint. We're showing the 5-day move ones. So these are the 5 numbers that go in that screen. I just didn't want to include a big of 15 numbers. So I think it was sufficient just to show 5 numbers here to give you to refer to. I start this at 0. Really weren't displaying we weren't displaying the current structure, but now we are. Okay. Now let me show you something really cool. If you want to project an increase in volatility, you simply drag this dot higher. Or if you project a decrease, drag it lower. To do that, you'll see the numbers in the table on the left update. And now we have left this dot on a projection of an increase of 6%, the 30-day volatility number. And then you see that lesser and lesser increases apply throughout the term structure, and that's just the way it should be. 6% increase brings us to 41.2. We had no projected increase, and I'm just clicking. That button there is a reset button, so you can click that to reset. And back to current volatility of 35.2, which you might be able to see in the matrix. Just have a look here. It happens we have options that with exactly 30 days of life left. So we're looking at the money's 35.2, so that should be at the puts too. Well, they're at 35.2 also. And back in the model volatility, there's our 35.2. So that may help you relate to you know what we're relating to. So that if you predict an increase or a decrease from a term structure, CEV automatically disables. I mean that if you want to project a certain structure, that you really don't want the program on top of that model other variations. When you model a term structure this way, I think you're trying to tell the program this is exactly what it's going to be, and so you wouldn't want to have something kind of surprising you in the background, adding additional adjustments. If you don't automatically disable CEV, however, if you want it enabled, you can click it back on, and then it's enabled. Ever click the reset button, we also automatically enable CEV modeling. Look at this. You'll note that if we project a decrease in volatility, although the dots get dragged down with it, and maybe too much sometimes, you can drag each of these individually, the term structure just the shape you want. That all these 5 numbers change over here, and put here is modeled in the Greek analysis, where we've got a long straddle here being modeled, and Trade Finder. Okay, so transfers over to graphic analysis and Trade Finder. Now, once you're in graphic analysis, you have to do is hover over this Volatility Change label and click it to get back to the volatility screen. You can make a change here, okay, and the graph will instantly update to reflect your change. And this number here, this minus 3.8 we're seeing right now, that should be the same number as this 30-day. So, and that's the case throughout the program now. Wherever you see volatility change, and there's a number of places where there's a volatility change field, when you change number there, you're entering a number usually that 80-day IV change. It reminds me, I think I go back to the graph just for a moment and something, because it's important. In the past, our blue line, our IV line, has not necessarily been a 30-day number. In fact, it's been something like 45 or something longer, because we've always included options that go to as much as 90 days, I think, something like that. But that's no longer the case. The blue line is now always a 30-day line, whether you're in this mode or not. Note that when I toggle this, the blue doesn't change back and forth. So the line is 30 days, and everywhere in the program that you're working with the volatility, working with a 30-day volatility, and that includes these numbers here in the matrix. Okay, we've standardized the program to a 30-day volatility. What now? Maybe I should look at what questions are coming up. See if there are any questions coming in. Yeah. How do Jim, I see my operational panel. About earnings dates. You know, I'm coming to that in just a minute. That's perhaps one of the exciting things to talk yet. Events. Yes, modeling events. Let's have a question here. question about the 60-day number. And yes, if there's not a 60-day option to measure them, and usually there isn't, they have to interpolate and arrive at that 60-day number by use some options that expire prior to 60 days and options that expire after 60 days. So it's just a matter of a linear interpolation there. Good question. Let's get into event modeling because we have definitely accommodated that, and with that, a good number of our OptionVue users are trading earnings announcements and other announcements that take place. So let's, what stock do I want to use? I will stay with Priceline. And the first thing that I would say to you is look at this jump right here between the weekly ones, currently 30.3, and then the weekly twos at 37.9. That's telling me that there's an event August 3rd and August 10th. And by the way, this is new to show the date in these header fields. So I hope it, and that's somewhat customizable. You can read about that in your real notes. So there is an event between August 3rd and August 10th. And when I look at my OptionVue notes, I can see that there should be an announcement between August 5th and August. By the way, I did not type all these dates into my OptionVue quotes matrix, my quotes display. They came in here automatically with a new function that's in development. These dates were actually picked up from the earnings.com and filled in for me automatically. So I'm planning to release that with the next release of the software. So you forward to that. All I have to do is, let me show you. I type Control E. When I hit Control E, the pros and refreshes every one of these dates and put earnings.com has right here in my notes field. So I don't know exactly what the date will be, but let us use, for sake of example, August 7th. So matrix back up here. Knowing that this expiration right here is the nearby involved event, I will highlight that column, click Model Volatility, and this field right here is automatically picked up on that weekly 2. Now the term structure is showing as 30 as the first dot. It's showing as W2 as the first dot. And we'll be modeling whatever happens using this W2 onward, because we don't care about any expirations prior to that. That should be obvious. This field, this is a new field here for the event date. I'll put in August 7th. And that event date is here. And we use a particular expiration to use as the nearby. We can now simulate without being a drop volatility. Now, how far should we drop this to? Well, for that, you probably would want to refer to the volatility and price charts to see what kind of a drop has had in the past. Let's not divert right now. Let's say that, for sake of example, that the I will drop to 32. But let's refer to the options. The options here are 30.7, so perhaps that is the floor level to use. If we this 30.2 here, indicating a drop of 8 percentage points for the U2. And offhand, it seems unreasonable to me that these are not flat, to just artificially flatten them by doing this. Another way is to type zeros in here, 0, 0, 0, 0. What is your S? with this term structure modeled, we can do a what ifing. Okay, we have, let's change this to a short straddle because I'm not sure a long straddle makes sense. Maybe it would. Let's go with a short straddle. And in the graph analysis, we see that one of the lines has automatically been put on event date, T plus 20. And valuation of the event is already displayed for us. So that's, we increase the number of lines if you like, but the event date being T plus 20, and there's a reminder here in the lower left, show there's an expected event modeled at T plus 20. Okay, and let me show you another thing that's new. Click for details. Column here that shows you exactly what the projected volatility is that's being used. Okay, projecting this drop to the 30.1, column puts the same, and that was the basis for the analysis then. If not, model this drop, and that would be done by me typing a 0 here, then you can see that this would be the you'd be looking at. But with the drop of 8%, then we're looking at. And break-evens of 831 to the downside and 968 to the upside. And if your preference is to believe that price line will stay within those bounds, then perhaps a short straddle is what you'd be looking for. And we could experiment with short strangles, with condors, butterflies, you like. In fact, to model set up this way and the term structure set up the way it is, you could use Trade Finder, ask it to, let's just set to work on price line, and a type of a bell curve. Excuse me. Excuse me. Anyway, set up your target, and the date needs to be that same August, I believe I said. Choose strategies and set your goals, and you could go. It may help you locate a profitable trade. I just thought of another thing I ought to point out while working. It's that a lot of these announcements will be after the market close. Apple, for example, coming up pretty here. Apple announcement is on the 3rd next week. I believe it's Tuesday. But this being after market close, it's important that you put in the date 4th of July, 24th of July, because the first full trading day after the announcement will be the 24th. Now, on the other hand, if it says BMO, then you can put that nice date. But if it's MC, then you'd better put the day after the dated date. I hope clear. Now, let's get that matrix back up. I'd like to show you one more thing, and that's modeling the sudden drop. You can also model the buildup that will take place leading up to the event date. So to do actually is indicate an increase, and switches the program over entirely to, instead of modeling any sudden drop, it does this increase that will place in a linear, gradual fashion between now and just before event date. Now, if we do a graphic analysis of that, that program projects to T plus 19. Remember that was T plus 20 before. It's important that it project to the day before the announcement. So what it does automatically, and then experiment with possible positions take advantage of the ramp up in IV, if you like. There's been a request, of course, to model both the ramp up and the sudden drop, but now we do not model both. We can only model one or the other, and so that's the way it is right now. If you indicate that's going to happen, then that tells the program to model the gradual increase. But if you indicate a decrease that's going to happen, the program assumes that that decrease will happen suddenly on the future event date. By the way, this is a drop-down also, and you can pick different expirations here, or you can pick the 30-day IV, which was the default. Now, see if we've got questions I can handle. Let's see. Able to sort by earnings announcement date? Yes, I hope to be able to develop that in that new feature in the quotes display. Said no audio, Len. I hope that that's not for everyone. I see the earnings announcement date on the chart, on the price chart or on the analysis. Here, analyze, it is telling you that the estimate is T plus 20. Date on the price chart? No, that would be a future that would need to be developed. Now, fine, so I assume that's fine. How this might affect Trade Finder? Well, it's Trade Finder foundationally, and every option trade that it might is using this horizontal model. You know what? I worked up a diagram. Let me bring PowerPoint back up here and view the horizontal skew model as being foundational to the vertical model. And I think it's a perfect way to visualize it. Every one of these little curves is the skew, this vertical skew model that's always been there. You can picture them as riding on top of the horizontal skew model, kind of like their base. And look at the term structure changes. See how the skews will just float on that and move up and down with it. So that's the way the model works. And I thought that this would be a good illustration to help you visualize it. Well, that's just about all that I intended to go over today. And is that you'll find new ways to trade with this and make money. And you know, I've heard from more than a couple people that calendars don't seem to be working very well lately. Maybe this is just the tool you need in order to go figure out why those are not working. My hunch is that it's just a matter of looking for the right spots, the right stations for putting them on, and maybe just put them on at the right times when the term structure is just should be well. And obviously that would be, you know, a curve. How shall I say it? A curve which way? Here, let's get this. Let's get up here. Perhaps calendars ought to be put on only when the term structure looks like this. I know that for sure, but you have your tool for researching it, and I hope I'll make a lot of money. Let's use the new term structure. Yes, absolutely. Only 5 years worth. The 5 years is just the historical data that you can do. I would say that the CEV numbers have from years worth of data. Every CEV number, all 15 of them in fact, are recalculated every day by our servers based on previous 10 years of data. So there. Yeah, that's the word I was looking for. Yeah, maybe you should put the calendar on only when the term structure is backward. What else here? Yeah, the complement, great changes. An earner and IBM worked like gangbusters today. That's good to hear. Tell me exactly when the existing position included drop down appears. The random. Existing positions included. On would that be? Would that matrix? Yeah, I call right now. I know what you're talking about. Well, I think that we're just about out of time, so we may just wrap it up now. Is this included in the survey function? No, survey wouldn't have to do this. Survey doesn't need the horizontal skew model whatsoever. It doesn't relate to it. Okay. I'm going to wrap it up now, so thank you everyone for attending, and good luck in your trading.